Steve, what about the fact that we have seen a decent chunk of cash making its way into tech stocks? What's been your observation there?
Yeah, well, one, I think there was a lot of pessimism in general coming into this year. There was a lot of cash on the sidelines, and people were positioned pretty cautiously. Last year was obviously an incredibly difficult year for anything in the growth space, tech in particular. I think the outperformance that you're seeing in tech, NASDAQ up almost 20%, is a reflection that, one, markets are telling you that interest rates have likely peaked. The Fed is probably going to be easing by the end of the year, and that we'll probably be returning to a lower growth environment where the growth premium that you're getting out of tech returns.
So is growth is growth a growth play, or is growth a safety play then?
I think for now it's a safety play. We think that it's better to have a balanced approach in terms of your allocations. Obviously, last year, anyone with that growth tilt got burned. A lot of people shifted to more cyclical sectors, and we're seeing those sectors, whether it's financials or energy, underperforming. Our base case is still that we're going to get a mild recession in the second half of this year, so we've been pulling back a little bit on some of that cyclical exposure and advocating a more balanced approach in our equity portfolios.
Steve, let's dive into the bank stocks themselves. I mean, the fact that, yes, we're obviously, when you see signs of confidence, seeing names rally, but I guess the broader concern seems to be, based on some of those recessionary factors you cite, is whether or not companies can deliver on the bottom line, the earnings picture. I mean, when you think of sectors where earnings might have to be revised, do the financials play into that, in your opinion?
Well, yeah, I think you're going to see that. Obviously, there's a big expectation that loan growth is likely to slow. Lending standards are going to move higher. So that earnings growth in the space is probably going to be under a bit of pressure, although some of the larger banks where you're seeing a lot of the assets flowing may actually be beneficiaries of that. I think the earnings expectations for this year for the broad market are still probably a little too high. They're not necessarily reflecting that recession that we expect. But I also think this has been the most well-telegraphed and anticipated recession in my career, and that investors are going to be a lot more focused on the earnings trajectory for next year rather than what we get for the back half of this year.
I guess we're all looking for a recession, but we don't know where the cracks are going to be in essence. Why not just put your money in a money market fund and hang out for a little bit?
Well, I think that a lot of clients are doing that. Obviously, there's some pretty compelling yields that you can get today. The problem is that the upside can happen so quickly, and we saw this in the fourth quarter of last year. We actually think that there's compelling opportunity in both traditional fixed income as well as equities. We're taking a more balanced approach, but you have to think about the fact that there is a lot of pessimism in markets today. I haven't talked to anyone who's painting a really bullish case. Fund managers are cautiously positioned, sitting on a lot of cash, and so if we do get that modest recession, we finally get through that and accept it, and the Fed starts to ease, you could see a big pop in the back half of this year that I don't think anyone's prepared for. If you're sitting in money market funds, you have to remember the time to put that cash back to work is really when things feel really bad, and that's hard to do.